So in our previous session, we were attempting question 4, November 2016, on international investment appraisal. So let's do a quick few minutes recap on what we discussed in our previous class, and then we can then build from it. So just a quick recap, just a refresher really. So Gugi PLC is a Nigerian company, and it was considering establishing a factory in a foreign country. And so in our previous session, we looked at appraising whether or not that investment should proceed. Now, a few things on international investment appraisal, which we discussed in our first class, we said, before you even begin to attempt the question right into it, we need to begin by identifying 3 key details so that you know the approach you're going to take. The first would be, you need to determine what is the duration of the project. And from our question, we could see that Gugi PLC's project was for 4 years. It could extend beyond 4 years if you have maybe some form of tax that extends into 4 years, or any other transaction that makes it extend to the 5th year or more than 4 years. Second thing, we need to determine what would be the relevant cash flows. And that would be basically be any expense, any inflow, any outflow that is related to the decision. So if you have an inflow or you have an outflow that is not related to that decision, then it would not be relevant. And then we consider the concept of cost of capital as well. We did mention that you need to identify early in the question whether or not you would need to calculate the cost of capital. If you're given it in the question, then we don't need to calculate it. If you're not given that in the question, then you just need to note that that calculation would be required in our question. Yeah, so move ahead, and then we discussed quite a number of principles from our first session. We said that we begin by determining the performance in a foreign country. We talked about how to forecast future exchange rate using inflation. So that's one of the things we did in our previous class. And then we calculated the value for the foreign entity up to the net cash flow in the foreign currency, which is $. Okay, so right up to this point, would there be any question right up to the point we stopped from our previous class? Okay, so if there are no questions, let's just get going from where we stopped in our previous class. So right now we've determined what the values are in the foreign currency. Now we need to repatriate the funds to our home country, which is Nigeria. We need to repatriate the funds to our home country, which is Nigeria. That's the key point. However, before you repatriate, you need to pay attention to whether or not there are any restrictions on repatriation. You know, that's one of the things with foreign investment. Sometimes you find a company will invest in a country, and then they struggle to repatriate the fund because there are some form of restrictions on how much you can repatriate from what you make. So if, for example, in this foreign country, Gugi could only repatriate 50% of its earnings from that country, it therefore means that what it would be able to repatriate would be just 50% of this. So what I'm basically saying is, before you begin to repatriate funds, you need to pay attention to whether or not there are any form of restrictions. In this case, there are no restrictions. So that therefore means that we can repatriate everything that we've made from the foreign country to our home country. So I think I should just add that as one of the key things we learned. We've discussed tax payments, so we've learned that part. We've discussed this. So another thing would be repatriation restrictions. Repatriation restrictions. So if there are any, please just make your calculation based on what the restriction is. But if you don't have any restriction, like in this question, we can repatriate everything. So let's repatriate all of the funds to our home country quickly then. Okay, so we'll just do our calculation here in Naira. So we're moving the money and we're calculating the Gugi leg of the transactions. So the years are year 0, 1, 2, 3, 4, 5. So years 0, 1, 2, 3, 4, 5. These are the values we had from our foreign country. 950 F dollar, which is our currency. I don't know what F stands for. They didn't tell us what F stands for. We had 175, we had 213, we had 211, we had 1810, and then we had 567. Now we need to trade or convert this money, this cash, or this net cash flow to our home currency, which is Naira. So we need to bring in the exchange rate so that we can do the conversion, or because we're moving everything to Nigeria. If there was a restriction of say 50%, it means that we can only move 50%. If there was a restriction of say 70%, it means that we can only move 70%. But in this question, there is no restriction. So we're able to move everything. So let's go back to our calculation of the exchange rate and quickly copy up the exchange rate. So where do we have our calculations on exchange rate? Yeah, so this is our exchange rate. The exchange rate now was 1.60. In year 1, 1.67. In year 2, 1.74. In year 3, 1.81. In year 4, 1.89. So that's year 1 to year 4. And then the exchange rate now, which is the spot rate, is 1.60, which is, so let's copy those up so that we can do our conversion. Okay, so that's 1.67, 1.74, 1.81, 1.89. We have the exchange rate now, which is 1.60. So this is the 4 years and this is spot rate. So because we have a 5th year, which arises because of our tax, we need to calculate what the exchange rate would be for the 5th year. So let's go back to that, our exchange rate calculation, and quickly calculate what our exchange rate would be for our 5th year. And that's because of the tax that we basically have. So let's go back to our exchange rate calculation and add 1 more year. Okay, guys, so we just add 1 more year, which is S5. So based on our formula from our previous class, it would be the exchange rate at the beginning of the year, which is 1.89. So this is the closing from the previous year, the opening for the year, multiplied by 1 plus the inflation rate of the variable currency, which is 0.1. That's what we've been using all along, because it doesn't change in our question, divided by 1 plus 0.056. Basically the same thing we've been using all along. Okay, so that gives us the exchange rate for the 5th year. So let's get that up quickly. Okay, so that's 1.1 divided by 1.056 multiplied by 1.89. So that's about 1.97. Okay, so that's 1.97. So guys, let's take our 1.97 up so that we can then make a conversion. Convert everything to Naira. So 1.97. So those are all of our exchange rate that we have from the foreign currency. So let's Let's do a conversion to Naira by dividing. Okay, so 950 divided by 1.60. How much would it give us as a net inflow country? Okay, so let's do that quickly. We just divide into Nigeria. Okay. Yeah, so 950 divided by 1.60, I have 594 in Naira. Don't forget, we are now in Naira. The next one, 175 divided by 1.67, we have 261. No, it cannot be 261 because that's 175. 175 divided by 1.67, we have 105 rather. Must have punched a different value earlier. We have 105. 213 divided by 1.74, we have 122. 211 divided by 1.81, we have 117. 1810 divided by 1.89, we have 958. And then finally, 567 divided by 1.97, which is the exchange rate we just calculated right now, we have 288. So we have repatriated all we've made from the foreign country down to our home country. So before we proceed, the next thing we need to ask ourselves would be, before we begin to think about tax, would be, is there any income that we've earned in our home country with regards to this project? Beside what they are sending to us, is there any other income that we've earned? And the answer is yes. We had one income which we calculated. Let's look at our income from our question very well. Just one that we earned in our home country with regards to this project. Now let's go back to our question. So it says here, unit royalty payable to Gugi, 300 Naira per unit. So the foreign country of investment will pay a royalty to Gugi. So when they pay, they spend money. So it's an outflow from their end. And so that is why we had royalty here. And that's why we had royalty here in bracket as an outflow. So when they pay, money goes out of their hand. But who received the money? Gugi received the money. So Gugi can account for that inflow in here as royalty received. Somebody's paying, somebody's receiving. And that person that is receiving is Gugi. And it's in Naira. So we already have the Naira value from our calculation before. So we just copy it and put it. We're not converting anything. It was in Naira. Where's the calculation? The calculation will be down. So we just copy the Naira value and drop it in where it's royalty. Yeah, these are royalty. So it was 33, 33, 33, 33 for all 4 years. So we just copy it and drop it down. Someone paid, someone received. Right. So someone paid, it went out of their hand and it entered into our hand right here. 33, 33, 33, and 33. So yeah, so that's about the only thing that we received apart from the net inflow that is related to this project for Gugi. Now let's go and talk about tax. Now, whenever you're dealing with tax on international investment appraisal, so let me explain it quickly, briefly, and then we come back and continue our solution. Because you might have different scenarios with regards to tax. So let me explain the principles quickly. And I will come back and look at that question. Right, so let's explain it briefly here. Treatment of taxation. So whenever you're treating tax, international taxation rather, now you need to take note that there are two scenarios with regards to international taxation. One is that there is a bilateral trade agreement. There is a bilateral trade agreement between both countries. So a bilateral trade agreement between both countries. So whenever we're treating tax, there are two possible scenarios. One is that there is a bilateral trade agreement, or what is called double taxation agreement. What is called double taxation agreement between both countries. So you need to know how to treat tax where there is a bilateral trade agreement between both countries. And the second is that there is no bilateral trade agreement. So it's either there is or there is none. So there's no bilateral trade / double taxation agreement. So let's begin with the second one, where there is no bilateral trade agreement or there's no double taxation agreement between the two countries. Now, in a situation where there is no bilateral trade agreement, guys, what basically happens is that tax is payable, the applicable tax rate is payable in both countries. The applicable tax rate is payable. The applicable tax rate is payable in the respective countries. So what does that mean? What that basically means is that let's use country A and country, or let's even use country A and country B, for example. So if the tax rate in country A is, say, 30%, country A will be, say, FX, and the tax rate is, say, 40%. Let's call it 40%. See, that's what is based on. And the tax rate in country B, say, Nigeria, is, say, 30%. Now, if there is no bilateral trade agreement, what it basically means is that the company would pay the 40% in the foreign country. So just like we charge tax of 40% from the money we made in the foreign investment, we charge tax of 40% here. So they will pay the 40% here, and then whatever money they repatriate to the home country, which is this Naira values, when the money gets to the home country, they will pay on that amount, they would pay 30% tax on it. So when the money gets to the home country, they will pay 30% on it. So they'll pay 40% initially. When it gets to the home country, they'll pay 40% rather initially, and then when it gets to the home country, they would pay 30% again as a tax in the home country. So you just realize that almost everything you made, you're using it for tax because you're paying the tax rate in both countries. And that's why oftentimes when companies want to invest in a foreign country, they tend to look for countries where you do have bilateral trade agreement with those countries. And why? Let's go to the principle of the rules on bilateral trade agreement. Bilateral trade agreement. So where there is a bilateral trade agreement, your total tax is equals to the higher rate, the higher of the two rates. Your total tax will be equals to the higher of the two rates. So let's explain it with three different scenarios so that you understand it perfectly well. And the reason I'm taking my time to explain this is so that if you have you can treat tax regardless of how it's presented to you in exams, rather than me just focusing on this particular example that we're treating right now. So let's look at 3 scenarios. So let's assume that you have $F and you have Naira. And let's look at 3 possible tax rates. 3 possible scenarios, and then we see how we would apply the principle that you pay the higher of the 2 rates. So let's assume that the tax rate in $F is 40%, and the tax rate in Nigeria is 50%. That's scenario 1. Let's assume that second scenario, that the tax rate in $F is 40%. The tax rate in Nigeria is, say, 30%. And let's assume in the third scenario that the tax rate in $F is, say, 40%, and the tax rate in Nigeria is 40%. So how would we treat tax under each of these scenarios? We said that your total tax should be the higher of the 2 rates. So let's apply that and see how it's going to work. Now you're always going to pay tax first in the country where you're making that investment. So if you're a Nigerian company and you invest in the UK, for example, you'd always pay the UK tax rate first, because that's where you made an investment. Before you even repatriate anything, you need to pay tax on it, except you want them to come after you for tax crime or tax evasion. So you always want to pay tax to that country first. So we pay tax to the investment, which is $F. And what is that tax rate? The tax rate is 40%. So we pay the 40% first. Now, when we repatriate the fund to Nigeria, we need to bear in mind that our total tax is the higher of the 2 rates. And the higher between 40 and 50 is 50. And our total tax cannot exceed 50%. So because we have already paid 40% outside, what percentage is left for us to take us to the higher of the 2? So that will be 50 minus 40, and so you only pay tax of 10% on the money you repatriate in Nigeria. So that's 40 plus 10, 50, which is the higher of the 2 rates. Let's look at the second and the third scenario, and then we'll take questions, because I need you guys to get it right. Look at the second scenario. The tax rate in the foreign country is 40. The tax rate in your home country is 30. You will always pay tax first where you make your investment. So you go ahead and you pay the 40%. Now, there is a bilateral trade agreement. If there's no bilateral trade agreement, when you move the money to Nigeria in this one, you would have paid. What percentage do you think we will pay here if there was no bilateral trade agreement? Let me hear someone's voice. In that first scenario, if there was no bilateral trade agreement, what percentage do you think would pay there?
You pay 30.
No, I mean the first scenario, the first one where you have 40-50. You pay everything. You pay the rate in every country. So if there was no bilateral agreement, you pay 40 here, you pay 50 here. Please take note. Yeah. But if there is a bilateral agreement, your total tax will be the higher of the 2. So let's look at the second scenario. You pay 40, you would always pay your tax in the country you invest first. So you pay 40%. Now, when you move the money to your home country, which is all of those money we have translated to Naira, you have to bear in mind that your total tax has to be the higher of the 2 rates. Between 40 and 30, 40 is the higher one. And you have already paid 40. So you will not pay anything in Nigeria. You will not pay any tax in Nigeria. If there was no bilateral trade agreement, you pay the 2. So you pay 40 there and you pay 30 in Nigeria. Now let's look at the second scenario. 40-40, the same amount. You would always pay tax first in the country you invest in. So you pay 40%. When you move the money to your home country, you pay the higher of the 2. So the higher between 40 and 40 is 40, and you've already paid 40. So you will not pay anything here. If there was no bilateral trade agreement, you pay 40 there and pay 40 here. So that's the rule and the principles with regards to international taxation that we're going to apply for our strategic financial management questions. So before we go back to our main question, do we have any question, any comments on how we treat tax with regards to international investments? Okay, so I guess we are good. Okay, so let's go back to our question. And as we look at our question, ask yourself, is there an international, is there a double taxation agreement or is there a bilateral trade agreement? If there is none, we'll pay tax, the full tax amount that it is in Nigeria. If there is, we'll pay the higher of the two rates. So let's go back to our question now that we understand what the rules and the principles are. So the money, the net cash flow. So where do we have tax? I don't want to read the entire question, so we just scan through it. Where do we have tax? Okay, so it says tax on the company's profit is at a rate of 40% in both countries. So it is 40% over there. It is 40% in Nigeria. If there's no trade agreement, bilateral trade agreement, or double taxation agreement, we'll pay 40% there and pay 40% on what we move into, or on the net cash flow that we move into Nigeria. But if there is, we'll pay the higher of the two. We've already paid 40% there. We've already paid 40% of the money we make there. So let's look at what, if there is anything like that. It says a double taxation agreement exists between Nigeria and the foreign country, and no double taxation is expected to arise. So on those cash inflow that we the profit we made from abroad, on the profit we make from abroad, what do you think will be the tax rate? We said our total tax will be the higher of the two. So what do you think will be the tax rate in Nigeria? We've already paid 40% there, and the higher between 40 and 40 is 40. So we will not pay any tax on the amount that the profit, on the profit that we made from the foreign entity. So let's go back to our question and see what we have there. Now it's down. Yeah, it's right down here. Yeah, so on this inflow that we move in here, we're not going to pay any tax because we've already paid 40% in the foreign country and it is the higher of the two. Now, but what of the royalty? The royalty, we didn't pay tax on it in the foreign country. It was an expense that they allowed them to deduct in calculating profit. So we didn't pay any tax on it. So we need to pay tax on that profit because we never paid any tax on it before now. So let's pay tax, calculate tax on just the royalty. If that was taxed up in the foreign country at 40%, then we don't have to charge tax on it in the home country. But it was a payment at their own end, which is a deduction from sales to get profit. So there was no tax on it. So we need to pay tax on it, which is 40%. But that is only on the royalty because it wasn't taxed over there. Okay, so what's 40% of 33? 33 times 0.4. 33 multiplied by 0.4. That's 13. Okay, 13. So that's 13. Okay, when is tax due? Is it due on this? Is it due in the year that we receive the money? Let's go back to our question so that we know where we are placing it. So don't be too fast to place it. We know that we received it 33 in year one and we're paying tax. But when are we paying that tax? Is it in that same year? Let's go back to our question quickly. Right. It says right here, tax on the company's profit is at the rate of 40% in both countries, payable 1 year in arrears. Payable 1 year in arrears. So the 13% tax we're meant to pay, sorry, the 13 the Naira tax we're meant to pay for year 1 is not going to be payable that year. In both countries, it is payable 1 year in arrears. 1 year in arrears. 1 year in arrears. And 1 year in arrears. All right, so I think that's basically it. So we can get our net cash flow. Okay, so let's do stuff. So this is minus, it's an investment, it's negative from up. Yeah, it's negative from up, so it should be negative down. The same thing with the last one. It's negative from up, so it should be negative down. Okay, so let's get it together. So this is 594. So 105 plus 33. This is 138. 122 plus 33 minus 13, 142. 117 plus 33 minus 13, 137. 958 plus 33 minus 13, 978, minus 288 minus 13. So this should be 301. All right, so we can bring in our discount factor then. I think that's basically about the final part. So we're given that in the question. So what's the discount rate? So we can calculate what the discount factors would be for the various years. The cost of capital is 13%. So the appropriate risk-adjusted cost of capital is 13%. So we just bring that in and then just calculate what the discount factors would be for that year. Okay, guys, so let's get our discount factor. Don't forget our formula for discount factor. It is 1 divided by 1 plus the cost of capital or the rate of return raised to the power of n. Or is that 1 plus r raised to the power of minus n. So whichever formula you use gives you the same answer. So this is year 0. Anything raised to the power of 0 is 1. Year 0, anything raised to the power of 0 is 1. Okay, so by my calculator, 1 plus 0.13 raised to the power of minus 1. I have 0.885. So when I multiply it straight up, so that I don't have to do it the second time straight up, I have 122. Okay, 1 plus 0.13 raised to the power of minus 3. I have 0.783. Okay, so by my calculator, 142 multiplied by 0.783, I have 111. The next one, 1 plus 0.13 raised to the power of minus 3. I have 0.693. So 137 multiplied by 0.693, I have 95. The next one, 1 plus 0.13 raised to the power of minus 4, which is year 4. I have 0.613. So this is still negative. 0.613 multiplied by 968, I have approximately 600. The next one, 1 plus 0.13 to the power of minus 5, I have 0.543. So 301 multiplied by 0.543, I have minus 173. Okay, so this first one is still negative. So 594 negative. So these are our present value. Okay, so what is our net present value? I have minus 594 plus 122 plus 111 plus 95 plus 600 minus 163, we have 171 million. That's because our answers from the very start had always been in million. So it's a positive NPV. So what's our recommendation? The project should be accepted. Project has a positive NPV and should be undertaken. Project has a positive NPV and should be undertaken. Okay, so that's solution to our Gugi question, guys. So we said in this lesson, we're going to learn a few things. We're going to learn the concept of relevant cash flow, which we've learned, inflow, outflow. We said we're going to learn the principle of double taxation agreement, which we discussed in this class. We said we're going to talk about forecasting future cash flow and explain how to do that from our previous class using inflation. You can also do the same thing using interest rate if you're given interest rate as against inflation. We talked about currency conversion as well, how to convert from one currency to another. So you should have learned that. Our presentation format, we discussed that there are two methods, which we discussed in our previous class. The one we use right now, and the other one, which I used briefly illustrated that it's going to give you the same answer where you bring in the tax allowed with depreciation, you calculate tax, and then you subtract it. Both methods, we proved it in our previous class, gives you the same answer. We talked about repatriation restriction. It's not part of this question, but we discussed it. So we mentioned that when you have your net cash flow, your profit from the foreign investment, which is this, sometimes there might be restrictions on what you can repatriate. So if the question, for example, says you can only repatriate 50%, that means that we will not be able to convert everything we have here to Naira. Rather, we only convert 50% because that is what the foreign regulation permits us to convert. So guys, that's a consideration of international investment appraisal. It's one of the top tested topics in SFM. It wasn't tested in May 2025. And so investment appraisal would always show up. So international investment is a likely one because it wasn't tested in May 2025. Any question on international investment appraisal? Any of the things we've discussed in this question? Any question? Okay, so I want to encourage you guys, take your time and resolve the question. If you need to go back to the video, you could just get to the YouTube channel and watch that and then re-practice it. And then you can look for subsequent questions on that. All right, let's now move on to another question, which is on decision tree.